Good morning to everyone. I hope you are all well and like always ready to take a course of today. I welcome you all to yet another session of taxation, and we are meeting for sixth time around since the start of the course, and we did not realize how the last weeks have passed by. And same way, the next 3 months till the same time around in the month of May when we expect to finish off things. Exactly, if I count from today, we have 3 months, March, April, May, will even go like this. We've been doing a lot of good things into our courses, and I hope at your side, you people are also getting the benefit from by taking a live session, first of all, and then later um, revising it by the access of board works that you have it, the recordings that you have, those are always in the drive, uploaded the very next day we take a live session. A little sorry for today, I'm feeling not so good. I have a coughing issue, so if probably you see my voice is a little different today. But yes, I'm here to take a course and will do my best to perform as I always. So without wasting any further time, let's get on to the board work. So to see what we have done so far and what are we left and what we can plan today for the next 3 hours. So as you are aware, we have been in the discussion of capital gains from the start of the course, and already is chapter number 17, chapter number 18, chapter number 19 we have finished. Chapter 20 is the biggest of all, on which we already have spent the last week whole. This chapter considers to have a lot of reliefs. 4 out of them we have finished in the past session. No, in fact, in the past session, in the recent session, we have worked the gift holder relief, we had worked the business asset disposal relief, and we have worked the investors relief. The rollover relief was even done before. So it gives us that feel that something is there to talk about, something is there to invest time, something is there on which we have spent the whole course of explanation, and still it's not finished yet. They still can expect to take the half of the course of today. And in the next half, what we will be doing, you will see. These are the two of those reliefs we are left, and we are starting the course by the relief called as PPR, Principal Private Residence Relief. These four I'm not going to touch since we have done, you people have got the access to watch the recordings of the last session, even a session before, to revise these four reliefs alongside its board work. These two are the ones we are left, which we can take a start of the course of today finally from. So I will take onto your page. We have PPR, Principal Private Residence Relief. First of all, whatever we are going to do in these two, totally different from what we have done in the past four. So what we've done in the ROR, what we have done in gift HOR, investors, business asset disposal relief, just totally forget about in the live course for a time being, because these two reliefs are going to be totally different. As you can see, all of those lecture notes being marked, suggesting we have been able to finish. All those questions came to our way for this relief, that relief, and all. See, this is business asset disposal relief. All have been done. Investors relief, all have been done. So yes, the page number 7 and 8, the two ones we are left, and we starting finally the course of today from this relief called as PPR relief, Principal Private Residence Relief. So let me try to give you first of all the theme of this topic, what this topic is all about, what we can expect to learn from, what sort of relief is it. As the name suggests, Principal Private Residence relief. PPR, Principal Private Residence Relief. Now, the word principal means main, and the private residence means the house. So it gives us that kind of clarification in the first that this topic is going to take the disposal of your private house, not the business asset. The house that you've been living in your life from the day of purchase till the date of disposal. This relief is all about disposing a private house and getting the relief on that relief is called as principal private residence. Why the principal word has been used, the main word has been used? Because if individual has got two houses, the person can own two houses, but one has to elect one of the house is to be the main one on which this topic will be applied. Both of the houses cannot take the benefit of PPR, only the one has to be elected as main on which this relief will be applicable. What I mean to say is, if individual own three houses and he has disposed three houses, whatever the gain that we have gotten the disposal of all three houses, the one of the house will get the benefit of PPR relief. So one has to elect out of those three of the houses, which one an individual wants to elect it to be as main house, principal private residence. So that's the reason why this word principal, the main private residence, has been used. Yes, if individual owns only one house, then one house by default is going to be a main private residence. Clarified? Let's see the basic theme of this relief, what we are expecting to learn. I suppose there is a house which has been purchased in the year December 2015 for a cost of 80,000. The same house has been disposed for whatever the price, December 2020-21. The proceeds on the disposal are given to be as 110,000. So randomly, hypothetically, I have been able to take those figures. So if I have to calculate the gain on the first, so I will simply be using that same technique of using the proceeds on the up, cost on the next. Simply the gain of 30,000 is worked. Simply the gain of 30,000 is worked. Now this gain, normally what do? We try to deduct the annual exemption from 12300, and then what becomes taxable, we come to make the use of the rate of tax. But this is where we will come to apply the relief, which is called as PPR relief. The gains will be exempt by a certain amount that one has to calculate by using a formula, which I can come to explain to all of you in a continuation of this topic. So this is the placement of PPR relief. It will exempt the gain by certain amount. It will exempt the gain by certain amount. So how this has to be applied, have a look. PPR relief equals to the gain of whatever we have worked, the gain of whatever we have worked, multiplied by the occupation over to a house, divided by ownership. In terms of months, this has to fill it in. In terms of months, what has been the occupation and what has been the ownership. Now, this is where you have to find the months of occupation and the months of ownership. The ownership runs from the date of purchase Ownership runs from the date of purchase to the date of disposal. Ownership runs from the date of purchase to the date of disposal. Like in this case, if I try to find the ownership months, I will be spotting the date of purchase, which is December 2015, which is December 2021. So I can count down the years involved: December 16, 17, 18, 19, 20, 21. There are 6 years. If I can count it once more, just to clarify if I was right or not: 16, 17, 18, 19, 20, 21. There are in total 6 years involved. So 6 years means multiplied by 12 times has to be 72. So I will come down to write that 72 months thing in the denominator. The ownership counts from the day he has purchased the house, the day he has sold. In between, whatever the number of months we have got are the period of ownership. Well, the occupation is when an individual has actually been living in, occupying in, residing into a house. So that cannot be the case. See, sometimes it happens we own a house, but we don't live in. So ownership is there, occupation is not there, because we might live abroad or we might live into another city by renting the house because of any reason, because we might have a work over there, we might have the workplace over here, we might do our business into that city. So we have rented the house near to our business premises, near to our employer's premises. So in that case, from my actual house, I am not being occupying. I'm owning it, but not occupying. So occupation can be the same as ownership. It can be different. In my very first example, I can assume for all the 72 months I have been owning the house, I have even been occupying. So I should come down to write the same thing up there. As a result of it, the gains, whatever we had worked up, are fully exempt. So this is from where you people can make a conclusion from that if the accommodation has been owned, occupied for all of the ownership, then the gain is exempt. I actually have been able to write the same thing over here that, okay, if the occupation is 100%, then the gain will fully be exempt. As you can see, the gain is fully exempt. 30 fully has become an exemption. But yes, if this 72 figure, I will change out to 70, suppose. So the exemption might slightly go down to 29,000, 28,000. Something in that case will become chargeable. All depends on this formula. Whatever the instruction you will give it to that formula, it will work the figure of relief and you will insert to get the answer. Yes, if it has been fully occupied for all of its life, then in that case, the gain will blindly be fully exempt. Like in that case. So right now, I'm trying to make you understand the way the formula works. But then I now will come to make you understand that how to look into the situations where the person has not been occupying the house for part of its ownership. This is going to be my next explanation after you're okay with the basic formula, the way the relief has to be applied. So ownership counts from the day he has purchased till the day he has disposed. And occupation is totally depending upon if the person has actually been living in or not. 5. If the person has been occupying the house for all of its life, the gain will fully be exempt, like in this case. The occupation thing is going to be our main focus now. There are two types of occupations. I can extend my explanation towards this occupation thing. There are two types of occupation: the actual occupation the deemed occupation. Actual occupation, the deemed occupation. Now, actual occupation, as the name suggests, is the case where an individual physically stays actually occupying the house, living into it. While deemed occupation is, if I have to define this word, dictionary meaning of this word is an assumption. Physically stays when the person is actually occupying, when the person is occupying it on the assumption basis. In reality, the person is absent. There is an absence, but an assumed occupation. So we will be assuming as if the person has been occupying the house. And this I need to come and explain that in which scenarios we have been given a benefit of assuming the occupation when the person has not actually been occupying. Still, we will be assuming that the person is occupying. So it's not that at any time we can assume. There are few guidelines, there are few parameters we have to take a good care of, within which we can deem the occupation while the person is actually not present or absent. There are some rules I can go to show to all of those rules or from the lecture notes. So actual is when the person is physically staying in, living in, personally occupying the house. Deem is when the person in reality is absent from his house or not present in his house, but we will be assuming as if the person has been occupying the house. So when can those assumptions be made? There are few rules for it. Let's go and have a look. First, we can assume the absence as occupation in the last 9 months of the ownership. If the person has not been occupying the house in the last 9 months of the disposal, before the 9 months of the disposal, we will be assuming that the person has been occupying the house in those last 9 months, maximum 9 months. It can be less than two, obviously 9 months, but it can not be more than 9 months. These are the rules that one has to keep in mind. You can't take this 9 months to be a stand. You can't take this to be 12 months. You are the next time. Up to 3 years due to any reason. Now, if you have been absent from your house because of any reason, personal reason, private reason, it could be any reason. We should not be interested in looking into any reason. We should rather be interested in taking 36 months of absence as deemed occupation if the person has not been living in his house for whatever the reason, traveling the world, uh, moving it out for conference abroad, or just to go and enjoy the holidays, or attend the marriage function, or just to stay at the friend's place, whatever the reason. Maximum 36 months can be deemed in that case of absence. Yeah, if the absence is more than to 36 months, then we will have to cap it at 36 months. We will look into it better when I will do this question in front of all of you in a while, where you will be able to understand in a good manner how to make the use of these months or the deemed occupation rules in a scenario before. But till then, just try to memorize the rules. Even if you can't memorize, that's fine perfectly, because those are there on the face of the lecture notes. Okay, any months within which an individual was employed abroad. Person may have been sent abroad for any sort of commitment. Any months during which an individual is employed abroad. Now, the person may have gone outside because of any reason. We have seen that out. This time, the person has left his house to work abroad, not vacations abroad. We might have been sent on an assignment by his company. So, or he might have got a placement somewhere abroad. Abroad means outside the UK, maybe in US or in Africa or maybe in Asia. Any months can be deemed if the person is absent in that context. Up to 4 years during which an individual was employed within UK. Now, this 4 year thing has to be remembered because employed within UK does not have um, any months thing in. That's maximum 4 months. That if the person has been actually been having a house in London, might have gone to work in Manchester. So Manchester is in the UK, not abroad. So this time, maximum 4 months or 4 years means 48 months can be deemed if the person has been working in the UK, anywhere else, maybe in Newcastle, maybe Everton, maybe Liverpool, wherever, but it has to be in UK. Maximum 4 years can be deemed if the person again has been going out for the reason of not enjoyment or vacations, for the reason of employment. These four cases to be learned, you will see the whole better use of that in application. If one of the questions I have seen from one person, you will also get to see this while I will solve it. So I was not wanting to really specify an answer based on whatever someone has asked me to a chat, because you will soon get to know your answer the moment when I will start applying this into the rules. So 4 rules. Number one, I can deem the absence as presence in four situations. First of all, in the last 9 months of the ownership before disposal, any reason 36 months, within UK employment 4 years or 48 months, abroad any months. Now, this is the best question. Yeah, if I wish to show to all of you what we have done so far, the way things are written back into your lecture notes, check this out. When the occupation is not the 100% of ownership, it is taxable. But yes, we know that the PPR is going to reduce the amount of gain. This is what I was trying to understand, make you understand that if the occupation is not 100% as ownership, means this figure is 65, then part of the gain will be reduced by the amount of the PPR that you may have subtracted 24,000, 25,000, 26,000. So gains will be reduced by the amount of PPR. This is the formula that I have explained out to you so far. Gains multiplied by the occupation by ownership. Actual is when the individual physically occupies. Deemed is when there is an assumption does not physically occupy, and the law is making an assumption, which in the four of those cases, the law is assuming. They want us to calculate the capital gains after reliefs, if any, arising on the disposal of house on 1st of Feb 2022. See, the house is disposed. The moment you will see this thing in your question, you will start sensing it out. Oh, they probably have tested me on PPR relief, because PPR relief is not applicable to any asset except the private house. House is not the business asset. House is supposed to be a place where you live in. So the moment the question suggests the disposal of house is happening, your mind should strike that this question probably has asked me on PPR. Letting relief is in fact a continuation of this topic. We will be doing that in about next 30 minutes. Main is PPR. Letting is just going to be an extension of it. You will get to see me doing it a little while after. So let's concentrate onto application 8. I will try to read out this application like a story in a one go, will not stop myself at any place. And then when I will come back to solve it, I will try to read it in parts and will solve it. Just try to read it like a story. You should have to also pay attention onto a screen. On 1st of May 1996, Alex purchased a house in Liverpool for £30,000, which he lived in until he moved to a rented flat on 1st of July 1997. So he actually owns the house in Liverpool. And then they're suggesting that he moved into a rented flat on this date. He remained in the flat until on October 1999 when he accepted the year's secondment to his firm's Boston office. So Boston is the USA travel, and the travel to USA is not the holiday, it's rather a secondment. So on coming back on 1st October, he moved into a relative's house where he stayed until he returned to his own home on 31st of Jan. On 1st July 13, he changed the job and rented the flat near his new employer's offices in Manchester. Here he remained until he sold his Liverpool house on 1st of Feb 2022 for 150,000. See, the question of PPR was meant to be like this, that he owns the house, and after owning the house, he has been traveling around. Sometime he is going to Boston. Sometime he's going to some rented flat. Sometime he has moved to the relative's house. Sometime he moves back to his own house and then moves back to Manchester. So it's like the whole GPS we have been able to fit into the person, and we are kind of tracking him around that where and when he comes and backs in, because the question of PPR is going to be like this. So I have to work it out by stopping myself on each movement, counting down the months in between, and then asking to myself a question that, okay, what sort of rules I can apply over to it from the deemed occupation. Very interesting this question is going to be, and all what is there, this one question will cover it. But first thing first, we have to calculate the gain at least. And the calculation of the gain has been the same typical old process, sale proceeds minus the cost. Application 8 is what we are here to learn this. So let me first of all write the date of purchase and write the date of disposal. 1st of May 1996 to 1st of Feb 2020-22. 1st of May 1996. Did I notice the dates right? 1st of May 1996. Yeah. And 1st of Feb 2020-22. Yeah. It's important because in order to find the ownership months, you need to keep an eye on these two marks. This is the day of purchase, and this is the day of disposed. So for how much they have purchased it out for how much they have disposed it out for, sale proceeds less the cost. Purchased the house in Liverpool for £30,000. The proceeds are given into the last. So at least I have been able to work the gain, which obviously requires to have a normal basic knowledge of capital gains tax topic, sale proceeds minus cost. This is subject to the relief that right now we are studying at the moment, which requires to have a proper calculation, and we are all up to the task working it out. Gain multiplied by the occupation months and divided by ownership. Let's go and find the ownership first, because it seems to be an easier task. Because ownership totally depends upon just finding the distance in between the purchase date and disposal date. That does not really matter where he is going out, coming back in. Just it depends on the day he has purchased the house, the day he has sold, which I can do it by observing it nicely. And you have to be also correcting me if I do some wrong calculations. See, the way that I do it, you can copy it. The way I do it is this way. When I see the number of years are plenty in it, like 1996 and 2002, most of you have been born on this year, roughly near around. So more or less the age of you, whatever you are at, probably the age of this house would be. since we are living into this year, which is 2020-22, and being purchased back into 96. So some of you may have been born in 96, 94, 95. So what do you do when you try to calculate your own age? You go back to the day you were born, and till now, you calculate it. The same has to be done in this. So it's not any tax working. It's something that you do it when you try to calculate your own age or someone's age. That is what we have to do it. So what I do, I don't do it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This will waste the time. I try to take bigger jumps of 10 years because when I see the gap is too big, so I just try and take the jump of 10 years. The first jump, I will take it till 2006. That's complete 10 years. The second jump, I will take it till 2016. I already have been able to count 20 years. Fine. Now, I cannot take a jump of 10 years because I know that if I will take a jump, I will land myself onto 2026. So I will try to take a small jump of 5 years. So from 2016, if I take a jump of 5 years, I will land myself onto 2021. So 25 years have already been counted. The disposal has not yet happened. Which day am I standing right now? 1st of May, 2021. So can I take a jump of 1 year now? 1st of May 2020-22? No, I cannot, because the date of disposal is 1st of Feb. So I'm standing it on 1st of May 2021 and cannot take a jump of 1 year. I rather have to go and count down the months. At least 25 years have been finalized. We are just trying to calculate the months over and above 2. And those months now we can count it onto fingertips. From May till Jan 31st. 1st of Feb means 31st Jan. May, June, July, August, September, October, November, December, and Jan. We have been able to count 9 months. So if the 9 months I am going to add into 25 years, 25 years are going to be about 12 into 300 months. So 300 months when add into, this is the number I have got. You can correct me if I have done some wrong calculations. I can do it. I'm a human, not a computer. So even I may have ended up working the answer wrong. Maybe the 1 month has extra been added. Maybe the 1 month have been subtracted. So it's fine. Someone has confirmed this out. We can now get into the main thing, the occupation. So have you seen? Finding the ownership does not require me to look back into the facts. Facts, I mean to say, moving in, moving out. I don't have to trace. I rather have to have the date of purchase with me and the date of disposal with me. Just need to find the distance. And I told you the way that you calculate your own age, same way you have to calculate the age of this house. Age of this house means with you. Probably this house may have been built even before 96. How old this house is being with you, the age is 309 months. Let's go to find the occupation. Now, finding the occupation months cannot be done on fingertips. Cannot be. It requires to have a proper table of calculations, which I can prepare this out in front of all of you. So on the left hand side, there are going to be the dates. Then we have occupation. Occupation can be the actual one, and occupation can be the deemed one. And there we have the absence. Let me try and draw the lines in between also, so that we can not be confused about mixing it up those columns. Yeah. So now it's automatically the computer straights the line. I don't have any expertise in drawing it up straight. So, okay, it's nicely been decorated, all organized in a better way. Let me put this once so that we can then concentrate on. So such a nice table I have been able to prepare. with the help of this whole technology. Now what I need to do, I need to start writing the dates onto the left hand side. And based on to those dates, I need to start punching the months. Some months might come into this column, some might come into this, some might come into this. In the end, we will be able to find the total. And by picking them out, we will be able to put them back into a formula up there to end the whole story. But the task does not look as difficult as in reality it is. It's not as simple if you're feeling it like. I just can give you that way by bringing it out the best possible question. But then in the end, it's going to be a challenging task. So please concentrate every bit of it. How am I going to fill this up? What is the first thing? I need to go movement by movement. Like, first of all, I will see the day the house was purchased was 1st of May 1996. So I will come down to write this date, 1st of May 1996. 1st of July 1997. 1st of July 1997. Now, can you see? I have been able to notice the first movement and I stop myself over here. I'm not moving forward. I'm not really bothered what's happening next. I have been able to at least notice the very first mark. The first mark is the day the house was purchased till the time he moved into a rented flat. On that date, I have been able to just notice the first mark. After noting it out, I need to go and check the dates if I have inserted rightly, because if I'm going to write the wrong figures, sorry, dates over here, my answers over here will be the result of. So I need to double check. This is 1st of May 96. This is 1st of July 97. Looks to me right. Once I have been able to write the dates this way by, now I can do what? I can try to calculate the months involved in. I will count down the months literally in it. So from 1st of May 1996 to 1st of July. 1st of July means 30th of June. What I can do for better, I can write this to be as 30th of June itself, because what happens when you try to write the July first, you might have a chance of even taking it. So better to write June 30th so that the chance of making a mistake can totally be mitigated. Now I can count down the months from 1st of May to June 1997. So from 1st of May till 1st of May 97, we have the whole year, and then the month of May and the June. So if the 2 months I'm going to add into 12, the total will turn out to be what? 14 months. The total will turn out to be 14 months. So now after calculating the 14 months are they in, I will ask the question to myself, what is he up to in those 14 months? So my answer is actually occupying the house. So I'm going to find the months and the column to write it in. I have been able to. And this is the whole game. We have to play from the top till the bottom. In the end, we will be able to pick the results from here to work. Good. Can I move into the next movement? Okay. The very next day is 1st of July 1997. This is the very next day, 1st of July 1997. He remained in flat until 1st of October 1999. So let's stop ourselves over here. Until 1st of October 1990 means I can write this to be as September 1999. September 1999. I can write it to be as 30th of September 1999. Once I have been able to write the dates, once again, I will do what? I will try to count the months into it. Let's count the months. July 98, July 99, there are 2 years into it. Then counting down the few months, which is July, which is August, which is September. So I can see 27 months therein. 28, 27 months. 27 months, not 28. Count it once again. This is something that we will make problem on that. Why? Because your mind has just started taking this for the very first time. So when you will get used to of it only when you will give it your mind a bit of a homework once or twice. When third or fourth time you will work the months, your mind will start digesting it even. 27 months, how did I count it? By watching it nicely, 1st of July till 1st of 98, and then 99, 2 years, and then July, August, September. October we cannot take. That's the reason why I have been able to write that as September 30th, so that the chance of taking the month of October can totally be removed. Ends up getting those 27 months. Good. Okay. Second thing, if you're thinking of that you're too much smart, which I know you will be smart, but if you will not do a working of this kind, it will be so difficult for you to even concentrate on dates, because in the question where you have about 5 lines, some dates are written over here, 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 here. You may not be able to pick the relevant date to make the whole analysis in. When you try to write this onto a piece of paper this way, then you can actually concentrate only onto it, rather being lost about, okay, which line am I into, which date I should belong to this thing, what should be the starting date, what should be the ending date. You will be always confused about, and this confusion may lead to take some wrong dates from. So better to write the dates this way, and when you write it, try to double check the way I'm checking it. Each time I write the dates, I try to double check that if I have been able to write those dates nicely, because my number of months that I have to calculate will be based upon this. So the mistake can start from this point. Need to double check it. 27 months I have got. Now, once I've got these 24/7 months, I need to also double check. I always do it. Even this time when I have been taking this topic for about 14 years in the past, still at the back of my mind, I try to double check so that I don't write the wrong digit there, and you'll be confused later about that how come it was 27 when the actual was 28. So please, at least check it once more. 27 months are right. Now, last question that I need to ask to myself, what is he up to in those 27 months? He has been living into a rented flat, which effectively means he has not been occupying his Liverpool house. So I cannot expect to write anything into this column. If you ask me, actually, I should come down to write 27 months over here. But this is now where we will go to make the use of the rules on leave occupation for the very first time. There are 4 options I have that I can use. First one, the last 9 months of the ownership, which we cannot use since the last 9 months are too far from this mark. That matching that the deem occupation rule, we cannot think of using it right now. Rented flat stay is not employment reason within UK or abroad. It means the only one rule that I can still use is this any reason. So rented flat stay is any reason. We're not interested. Why is he living into a rented flat? We're not even wanting to investigate. We only can come to make the use of this rule that up to 3 years or 36 months, I can deem the absence, which is what I am going to. So let me rub this off from the side. Actually absent, but assumption is made as if occupying the house by using the rule of any reason. And this case requires you to also concentrate then, if any reason have got 36 months in total, if any reason has got 36 months in total, then we already have been able to exhaust 27 months from. So that next time we have to go and make the use of this rule, I only can take 9 months from. That is also important. Keeping the record of the months you have exhausted from that rule so that you won't be able to use that again. about 40 minutes into the course right now we are in. Can't you see whatever the explanation that is happening right now is totally different from what we have been doing it the last session? Totally a different world PPR. You have to prepare it. The way the course of today is trying to make you prepare. On the other side, it's very interesting even. It's not as boring as some other reliefs were. Okay, moving forward. Next. Now, what next after rented flat? On coming back on, no, he remained in flat until this date. Fine. What's next? He accepted the year's conference to its firm's Boston office. Now he is traveling to Boston, which is in the US, USA. For what reason? Holiday? No, work reason. So now we can have a chance of using the rules of deemed occupation when the person has gone abroad for a work reason. Any months can be deemed. So just need to count the number of months and put this into a column of deemed occupation. This is October 1999. Until when? On coming back on 1st of October 2000, which once again I can write it to be as 30th of September 2000. It's the whole year, 12 months if I precisely see it, October to September, that's a whole 1 year. So 12 months I can come to easily deem it over here. See, if the rules for the deemed occupation do not exist, I would have put both of these months over here. But because of the use of the deemed occupation rules, we are deeming the absence as presence. Next, after Boston, on coming back on October, he moved into a relative's house. Oh, so he's still not going back to his own house. He moved into a relative's house where he stayed until returned to his own home. Finally, on this date, he got back to his house in Liverpool. So from October 00 to Jan 31st, 2001. How many months we see into it? October, November, December, Jan. We can see 4 months into it. And these 4 months obviously are not the months of actual occupation. Should come down to write it into deemed occupation or absence. We'll have to see if we do have any option of deemed occupation for that. What is happening in those 4 months? Still any reason. And still any reason, we can still use how many months from 9? So let's go and use further 5. 4 from. These 4 months are further being exhausted from the any reason, October, November, December, January, yeah, fine. And finally, this is the day he got back to his house. The very next day, he has been living in his own house. Let's see till when he physically or actually occupies. Now, you must have been realizing what I was saying, that you cannot do this calculation on fingertips. It requires to have a proper table of calculation. Ownership can still be done on fingertips because ownership is just about observing the 2 marks, the purchase day and disposal, and finding the distance in between. But occupation to find is a serious thing. Without a table, you cannot. Probably you have realized it. Okay, what's next? On July 13, he changed the job and rented the flat. So this is once again, he is moving it out. So quite a long stay. Let's go and count the months in between 2001 to July 13th, which July 13 means I can come to write it as June 13th. Writing it first July 13, June 13, yeah, fine. So July 13, like I always have said, writing the first July in fact means 30th of June 2013. Let's count the number of months in between. Those are involved. 1st of Feb 001 to 30th of Jan 2013. I can see I can take a jump of 10 months, 10 years, because that's Jan 1. I can take a jump of 10 months. Years means it will go up to 2011. Yeah. And still 13 is not full. So 10 years are completely there. Let's see how many years we have to further take it from. I'm standing it on 1st of Feb 2011. So I can take 12 also. I can take 13 also. And still not this date has been touched. So 12 years have fully been counted. 12 years. Let's see the months we can take: Feb, March, April, May, June. We have 5 months to take. So 12 years in 5 months, and 12 years means 144 plus 5, 149. So looks to me this 149 is going to be the months of actual occupation. Obviously, actual is actual. You do not need to think much. Rather, you just need to punch in the right figure into this, which I have been able to: 148, 150. No, it's 150, 49. And we have been able to punch it into 8. Fine with this. Good. No problem. Now, finally, he has gone to Manchester not to watch the football match. Rather, he has changed the job and rented the flat near his new employer's offices. So he has actually been sent to Manchester to work at a new office instead of Liverpool. So within UK, he has been working 4 years. Remember that one rule of deemed occupation, still we have to use it for this reason. Up to 4 years can be deemed when the individual was employed within the UK somewhere else. So yeah, he has not been employed in Liverpool anymore. He is rather gone to Manchester to work. So we have to count down the months, because after this, there is no further movement. This is the day he moved to Manchester, and here he remained until he sold his Liverpool house on 1st of Feb. So this is going to be the last most movement. And this movement looks to me quite a lengthy movement once again. This is July 13 and all the way down to Feb 2022. We have about 7 years, 8 years. We will go to count it nicely. 1st of July. Definitely this column is not expecting to do anything. This column is not expecting to take anything. He has not been living in his house. He has rather been living in Manchester for work reason. What you need to do when you are approaching to the last part of the question means when you're left out with only the one movement, like in this case, then you will have to start working from backwards, and not to miss the chance of taking the last 9 months, which is what I have been able to take it. And this is where I'm making the use of the last 9 months of the ownership by working backward. I also can go to write the dates of these last 9 months by checking the date of disposal. The date of disposal is 1st of Feb 2020-22. 1st of Feb 2020-22. Now, to write it as 1st of Feb, I can write it as 31st of Jan 2022, just to make things easier, because 1st of Feb effectively means 31st of Jan. And the last 9 months, the date of that will be what? First of, it will be 1st of some month, and the year has to be 21. I'm trying to move backward and trying to find the start of 9 months, and little difficult task. And you always can have a chance of writing the wrong month into it. But by double checking it, it can simply be minimized. Okay, so which month I should go to write it in 9 months before? It should be the month of June or May or July or August or September. Should be a month of May. Now, suppose if it is a month of May, I have been able to calculate it. What can now be done? You can always try to then count forward to check this out, that if you end yourself on 31st of Jan or not. So let's start. May, June, July, August, September, October, November, December, and Jan. See, I've landed myself on 31st of Jan, the same month that it should end on. It means the month of May that I have found was a perfect one. These are those 9 months that I have been able to deem it in advance, because I was not wanting to lose these last 9 months of ownership. I have been able to take them in advance. See, how am I going to construct this date in between? The very next day, this ends from This is going to be 30th of April 2021. See, did I construct this? This period, I haven't constructed it from the question. I rather have constructed this by this way. The very next day the previous ends, this will start. And the very previous day, this next year it starts, it will also end. This how the arrow clearly indicates how did I find the starting and ending date of this period. Now let me count down the months in between. July 13 to 2021. I cannot take a jump of 10 years because this will land me on 23rd. Not happening. So I will go year by year. 14, 15, 16, 17, 18. 14, 15, 16, 17, 18. 19, 20, 21 I cannot take. 20. So 7 years have fully been counted and few months. July, August, September, October, November, December, Jan, Feb, March, and April, 10 months. So my answer is 7 years and 10 months. 7 years means 84. Yeah. And 10 months means 94. 94 months I have been able to find. You correct me if I have done it wrong. 84 months because it was 7 years. So 7 multiplied by 12 times is 84. Plus 10 months or 9 months. No, there are 10 months because July till December, we have 6 months and then 4 months to, 10 months. So 94 months. My last thing in this question to ask that, okay, in those 84 months, sorry, 94 months, what is he up to? The answer is very simple. He has been working in Manchester in those 94 months. Is it? In those 94 months of absence, he has been in Manchester for work. So out of 94 months, how many months I can deem? I can deem 48 months because of UK employment, because of UK employment. Yeah, I can also deem 5 months from any reason. See, these any months could have been used once again. Any reason. When I was taking a good care of, I found it out that, okay, this thing has been there already. What is the balancing figure that I have got? 48 plus 5 minus 94, the figure is 41. Now these 41 months are the months that cannot be deemed, because for this 44 months thing, we do not have anything to use. We cannot use anything to use. Are you realizing? We, within UK, we have used it, exhausted. Maximum 48 months could have been deemed, we have. 5 months we could have used, we have. Now, other than that, last 9 months, we already have used it there. Abroad employment not applicable. It means these 41 months are the months that I cannot do anything for. I must have to go and write them in the column of absence. Out of 94, these 41 months cannot be deemed. So I can write it primarily, we cannot be deemed because we do not have any rules of deemed occupation for this 41 months being left. These two we can by using this rule. 48 months because of UK employment, 5 months because of any reason. So 53 months could have been deemed, 41 we cannot. So I have been able to write. It means based on what we have decided, I can come to write 53 months over here and 41 months over here. But this is where also you people will have to understand something very important. That important thing is what? The rule is that whenever you have to take the benefit of the rules of deemed occupation, it must be followed and preceded by the period of actual occupation. which has been the case in all the last deemed occupations I have achieved. The person had been occupying the house both before and after, which has not been the case now. He has been occupying the house before he has left to work in Manchester, but he never got back to his house to physically occupy, as you cannot see any actual occupation after, even for a month. If it was there, I would have accepted, but that is not there. In that case, the rules of deemed occupation cannot be applied, and this will end up writing me the whole 94 months into the column of absence. If this exception did not exist, I would have taken the 53 months over here and 31 over here. Sorry, 51 and 53 and 41. I was telling you that 54 months I could have used it here. 41 I could have used it here if this exception did not exist. But I just have been able to explain to you off that if the period the person has not been occupying the house both before after, the rules of deemed occupation cannot be applied. Why did I use the 9 months? I should have not even deemed this also. Let the explanation to end first before 91 months we have. 94. Correct me if the months are 91 or 94. Someone is just trying to correct so that I can base my discussion on to 91 months. Let me try to once again check if it is 91 months. At least there are 7 years, because if I look from this point of mark to this, I can count. Yeah, someone also has got 94. I also can see there are 94 months in. See, first of all, at least we have 7 years. Let's try to resolve the confusion by counting it once again. First of all, we have 7 years, at least 14, 15, 16, 17, 18, 19, 20. 21 we cannot take. So 7 years we have, which means 84. Then up then 84, we have July over here, which needs to count it till April 30th. Safely, it cannot be 91. Safely, it will be 10 months. So 10 months to add into this, the answer, yeah, you have probably corrected now. So 94 months are right. Let's get back to discussion. 94 months, if we have, I could deem 48 months, 5 months by using these rules. These cannot be deemed. So if I go by this, I would go to write 53 over here and 41 over here. But there I came to explain to you one of the exception. The exception is that the person must have to physically occupy the house both before and after to apply deemed rules of occupation, which has not been the case. It has been the case in the past. Check this out. All the rules of deemed, we could apply it that the person came to physically occupy the house after and even was before, but that was not the case. So therefore, this made me to write the whole 94 months over here. Now you must have been having this question mark coming to your mind. Then why we have the last 9 months then? We could have write this 9 over also here. If we are not deeming these months, we should not even be deeming the last 9 months. Why have we? Should be asking this question or not? I thought someone has asked me a question on to it, but in fact, there was a confusion on number of months. So I want to draw your attention to this last 9 months. Think that why have I deemed it? If I'm not deeming the rest, why did I deem the last 9 months? I should have come down to write this thing also over here. And the answer to that is what? The exception that I have just talked about is applicable to rule 224, which means these 3 rules that we are having it with us will take this explanation the first last 9 months, but anyhow you have to apply regardless of the fact he comes back in or he does not. We have to apply. See, the rule 2 to rule 4 means this one and this one must be preceded and followed by the period of actual occupation. So that exception is applicable to the 2 number rule, the 3rd number rule, and the 4th number rule, not to the first. First rule is a rule of 9 months, which at any cost, we have to take it. This is where this whole effort and the table has come to an end. See, such an effort, because after that, what it will be now? It will be just about counting the months into each column. and using the same months onto calculator to get the answer. That is the only thing being left out. 14. This is 163. 27 plus 12 plus 4 plus 9. This is 52. And that's about 94. Figure is 215. So this is the gain that I have been able to give it to that person, 83495. 83495 minus 120,000. The figure has turned out to be 36505. Okay with that. So what has taken the time? Now, clearly you can see what has taken the time. The time has been mainly spent on occupation. Mainly spent on occupation. The number of months remain to be used under any reason rule is 5 months. So yeah, I've used the 5 months or not? 5 months I'm using it. The number of months remain to be used under any reason rule is 5 months. So yeah, I'm writing the 5 months. Where did I not write the 5 months? It's everywhere 5 months. 5 months remaining, 5 months remaining. Where didn't I use the 5 months? If you are, or maybe I'm not getting your question. The number of months remain to be used under any reason rule is 5 months. So yeah, probably I'm not getting your question. 5 months. 5 months. Everywhere 5 months have been written from any reason. Yes, is the confusion resolved? The one who has asked me. We have used 9 months. From 1st of May 2021 to 31st of Jan 2022. So these are the last 9 months of the ownership. Why you're confusing the 5 months of any reason with this? We have used, if you have any individual concern, you're not getting it right, just do come to ask me to clarify. This question was getting finished and I guess no one was confused about, you have put some confusion on. This 9 months have got no connection with that 5 months thing is not. And sometimes it's happened in the live course. If one of you got stuck on something, you should come to ask me for that, not to just feel it by that I did not get it, probably the others they've got, so maybe I'm not getting it right. So you should come to ask me, try to review it once the course today will finish, try to watch the recording of it, the board work of it, or sit in a relaxed manner and peacefully try to read out the whole solution. Probably in this way you will be fine with, but still not fine, come to reach me personally, individually. I will come to entertain you. But this last 9 months have got no connection to that 5 months thing. This I have been able to write it in advance because at any cost, these last 9 months, we have to take it. And not to lose the benefit of that, that's the reason why I started working backward and taken those 9 months in the first slot. So that the balancing number of months that I will find, then I will go to decide about what to do with it, which I've decided already that all have to come into an absent month because of this recent explanation of no actual occupation followed by. Okay, good with this. No problem. And such a nice manner by spending about almost an hour onto this question, we have finished it up. This is the one best question that I could bring it into the course of today to finish on PP. As you can see, all the rules of deemed occupation we have applied in. This was any reason. This was abroad employment. This is last 9 months. And Manchester within UK employment, I was going to apply. After explanation of that whole, although we have not applied, but I was going to apply it. And then you also have been able to understand that exception in. Not the exam question will be that lengthy as you can see right now in this application, because I, in this question, have been able to cover all the points. But not all the exam questions will have this kind of a length in it. The exam question might be testing you on maybe two maximum movements, one rule of deemed occupation, any of it. This at least have covered all in the feathers of its own. All the four rules of deemed occupation alongside that exception well covered in. Fine, no problem. And whatever on that page you see, finished it up. Do you see anything that has been written on that page and have not commented on? By the time this relief is finishing it off, all what we have seen onto that page completed. This will allow us to move into a letting relief. There's something being done on the way we also can do it. Application 9. It tries to highlight one little thing. Let's do it. On 17th of October, Lam sold his house for 300,000. This is application number 9. The gain is given and the proceeds are given as 300,000. The gain was given, the proceeds are given. If the cost was not given, we do not even need that out, but we can find this to be as a balancing one, which we have found. This 190 we have found out to be as a balancing one. The house had been purchased on 1st of September 2017, and one of the 5 rooms have always been used up for the purpose of. Now, for this reason, I've taken this question for that. What if the part of the house has been used for business reasons? Because actually, this relief is applicable to a private house, non-business asset. Is it? So if part of the house has been used for business reasons, then that part will lose the PPR relief. And that part is 1 out of 5, which means 20%, which means 20%. So the relief will be on the 4th by 5, and the gain will become charged by 1 by 5. This will become chargeable. And that will become it. This is the only thing that was wanting to work it out into it, that what if the part of the house has been used for some business reasons, that part will never be relieved, rather will become chargeable. 1 out of the 5 rooms have been used. This is not the question of applying the rules of occupation, because the question never states that person has moved out, moved in. So it's the question of this kind where the occupation matches the ownership. And I was going to make the whole gain exempt, but I have not, since I got to know 1 out of 5 rooms have been used for the purpose of business. That portion could have not been relieved, and we gave rather to charge 8. The balancing figure has been exempt, which in fact is the 4th by 5th portion of it. See, the taxpayer cannot get the benefit from the rules of deemed occupation for any part of the property being used out for the purpose of the business. So the whole of the gain has been exempt, the portion that belongs to non-business, 4 by 5 rooms. And what we came to charge is, what is letting relief? As the name suggests, letting. If the PPR is let out, the letting relief will become applicable. If the PPR is let out, the letting relief becomes applicable. How to apply it? the letting relief takes the lower of two things. Now, on top of PPR, the letting relief is going to be in addition to it. PPR relief will still be there. Letting relief is going to be another relief. On top of PPR, we have to apply. If the PPR is let out while an individual still resides in and lets the remainder. Happens or not, part of the house has been rented out. If there are two stories, one of the story has been rented out while the ground floor is still the one on which the individual occupies. So it's applicable not to the case where an individual has totally been moved out and the whole house has been let out. Rather, a case where part of the residence has been let out while the owner, the individual, still resides in on the remainder. So how to apply? The letting relief takes the lower of three things. The fixed limit of 40,000. Now this is a fixed limit, not an example. The amount of PPR. The amount of letting relief. After working the figure from this side, we will have to see which one is the lowest one to finally use that amount for the letting relief. While the amount of letting relief to work takes us down to the same formula. That formula is what? Gains multiplied by letting months divided by the ownership months. Same formula, except using the months of occupation, I will be able to use the months of letting into it, while the denominator will still take the ownership. Gain multiplied by the letting months divided by the months of ownership. So whatever the answer we get, I'm not telling you this is going to be the final answer. We will still have to check the lowest of all three to finally say that the letting relief is going to be this amount. This topic does not itself have anything to understand, except the only thing you have to remember it, this topic becomes applicable when the PPR is let out and in an arrangement where an individual still lives in a house while letting the remainder part of it, not entirely that person has moved out and letting it out to someone else. But in that case, that house will never be called it to be as the PPR for that person, since the person has not been residing by himself in. PPR is only when the person has been occupying the house by himself and letting the part of it. That part could just be a one floor of it, maybe some portion of it, the rooms of it. See, letting relief is applicable only when an individual lets out the PPR. How to? The lower of three things. The figure of that 40,000, the amount of PPR, and the amount of the gain that attributes to the period of letting. Nothing more than that. Any text you can see being written here, except the question we have, we can plan it to solve it out just to finish this explanation. Calculate the capital gain after release arising on the sale of house. So the sale of house is involved, which is what we will be calling it to be as PPR. On September 30th, 2001, Alan made the gift of the house to her grandfather or daughter. It's a gift. Or may have been a sale. Sale gift, we know that the same thing, both are chargeable. The difference only that in the sale transaction, we take proceeds. In the gift, we take market value. Otherwise, market value minus cost, sale proceeds minus cost. Gain is to be worked by using the proceeds or market value. Gain, we should know how to work. The house had been purchased by Alan on 1st of September 8 for 51,000 and was extended out at the cost of 12100. So extension cost, acquisition cost, both we will take. a market value of £150,000 at September 2001. Now, market value is necessary. Why? Because it is a gift. Alan occupied the house as his main residence until this date, a period of 109 months. So when occupation is involved, this gives me that actual occupation. During the month, Alan rented out. Now, finally, that rented out thing coming onto Arvind. 1/3 of the house, 1/3. It means the 2/3 portion of the house he must have been occupying by himself. 1/3 has been able to for 96 months. The tenant did share any living space with Alan. Alan then went to live with his brother for 48 months until September. So living with the brother for 48 months is an absence, which we can have a chance of deeming it under the rules of any reason. And that last 9 months things also. Reading the question, when you read it out, you find a lot of movements into it. But when you try to do a paperwork of that peacefully, one by one, movement by movement, table of calculation, then it starts becoming easier. Like this question. It was massively difficult to answer, but the way we had organized the answer of it was becoming easier to understand. Okay. Now, this is application number 10, the last one for this. Oh, in fact, it's a gift one, so I should rather use the market value. Never mind. What is the market value being agreed for purpose of capital gains tax? 150,000. We'll have to subtract the cost of acquisition. We'll have to subtract the cost of extension. Acquisition cost is 51,000. And 12100. This is again, we have been able to work 86900. Will be subject to two reliefs. The PPR is primarily a relief we will consider. The letting is going to be the next one. Let's analyze the months. The PPR, the formula that takes on the very first the gain, which is 86900, and multiply this the ownership months and occupation months. And we know that it's easy to find the months of ownership. That reason we need to go and spot the date of disposal and purchase date. This is the day the house was disposed. And this was the day back in 2000 when it was being purchased, 2008. Let's go to write those two dates in front of our eyes. 1st of September 2008 and 30th of September 2021. So how many months we see in between? I'm doing the same task as I've done it in the previous question. I'm trying to find the months of ownership first, because it's easy to find purchase date, disposal date. Let me go to double check. 1st of September 2000, yes, 2008, and September 2021. Fine. So let's find the months into it. Did I tell you the approach of taking a long jump of 10 years? If I do it, I will land myself on 2018, which is fine, 10 years. And then 19, 20, and 21. 3 years have further been counted. 13 years are completely there. 13 years are completely there. 13 years are completely there. And then 1 month to add, because that's 1st of September and that's 30th of September. 170, 57 months I have got. These are the months of ownership. I have been able to write it into denominator. Occupation to find is always a bit of a challenge. And we accepted that challenge out in the last question, which was more difficult than the one we are solving right now. And we will be able to work it out once more easily. Let's try to analyze the 157 months. Out of 157 months, they were suggesting the Alan has occupied the house as his main residence. Look into this line. Alan has occupied the house as his main residence until September 17, a period of 109 months. So out of 157 months, they have told me about these are the months of occupation, actual occupation. So it means 109 minus 157, what is going to be the absence? 48 months are the months of absence, which we might be having a chance of deeming based on the rules that we have. What was happening in those 48 months? Let's try to inquire. During this period, Alan rented out, forget about, the tenant did not share any living space. Alan then went to live his brother for 48 months. So this is with the brother at brother's house. In those 48 months, the reason of absence was any reason. Fine. It means for any reason we can deem 36 months. Alan then went to live his brother for 48 months until September 30th. Okay. Safely, out of this, I can deem the last 9 months. These are the last 9 months deemed. Remember, I told you that when you are into the last movement, you have to make sure not to lose the benefit of the last 9 months. This is in the first place, you have to come down to right. So out of 48 months, I have been able to deem last 9 months. The balancing is what? 39. Can I do something for these 36 months? These 9 months that I have deemed because of the reason of last 9 months of ownership. Can we deem those 39 months? We can deem because of the reason of any reason. How many months we can deem because of the reason of any reason? 36 months. But still the same logic will come to play that he has never come to occupy his house actually. So the rules of deemed occupation cannot be applied. Cannot be deemed. Exception of occupying the house both before after. So before becoming absent, he has been occupying the house actually. But after he has never occupied and sold his house. So because of that, the last 9 months still could possibly be deemed, but those 36 months we could not. The whole 39 months I have been able to write cannot be deemed. At least the 9 last months we could have taken it out from, we have taken. It is exactly the same point I was discussing it with that Manchester stay, that he went to Manchester, where he stayed there until he has sold his house and never came back to occupy the Liverpool house. So we had not been able to apply those any reason deemed rules there within UK employment 48 months there. Same logic is applied. I was going to apply 36 months of deemed occupation. But then when I realized that he got back to, when he went to live as his brother's place, he never got back to his house to occupy. So the rules of deem cannot be applied, within which the last 9 can still be. So this is resolved now. We know what we have to do. We have. Let's go back to 109 months to see what's happening in those. These 109 months are the months of actual occupation. Then they suggest Alan rented out 1/3 of the house for 96 months. So I have to split this off into further 2 parts, 96 months. 96 minus 109 is what? 13 months. These are the months in which there is a letting going on. These are the months in which it has fully been occupied. Fully occupied. There was no letting. But these are the months from which I need to split this off in 2 parts. They say that out of 96 months, 1/3 of the house has been let. 1/3 of the house has to be what? 1/3 of 96 has to be 32 months. That means it has to be 64 months. These are the months of letting, let me label it, in which it has been occupied. And these are the months of letting. So this analysis is very important. The way I've done this out, see the whole process, the way I've done the analysis. I started from 157 months on the up. Out of 157, I have been able to split this off into two broader parts. 109 months of occupation, 48 months of absence. Within those 48 months, 9 months could possibly deem, as we always have to. In 36, 9 months, I could have a chance of deeming it by using the rule of any reason, 36 months, but I have not because of that exception of occupying the house, which has never been the case. So I had decided not to deem it. And then when I came down to 109 months, I found out of 109 months, 96 months are the months in which there has been a letting going on. So what about the rest of those 13 months in which it was being fully occupied? Within those 96 months, it's not full letting, half, 1/3 of the 96 months being let out. So I have been able to find the 110 months. This has been occupied. So if I can knock out the occupation 64, 13, and 9, total occupation will turn out to be 64 plus 13 plus 9. That's about 86. Should be using it up there to get me the answer of PPR relief. 86 divided by 157. 47601. And now we can find the letting months, the lower of three things. In fact, I can copy and paste this entire explanation so to save a bit of a time. Amount of PPR is already being worked. That figure is 47601. I can write it 47601. The gain is 86900. Letting months are 32. Ownership months are 157. One double seven, 1, 2. This is the figure I've got for letting 177, 1, 2. Selection is based upon by picking the lowest, which naturally we have to pick this up 177, 1, 2. When I taken this up there, the answer of that question has been worked. 177, 1, 2 plus 47601 minus 86900 from the figure has turned out to be 21587. See, the main crucial part of this question is this 157 months calculation. So try to work it out. I'm once again revising it. I already have revised this out many times before. 157 months are the months of ownership. Now, within those 157 months, we have divided this in two parts. 109 months of occupation, 48 months of absence. This is something they have told me about. In absence, 9 months straight away, we have to deem always, which we have without thinking much. What about the rest of the 39 months? We could have a chance of deeming it any reason 36 months, but I have not, since you should have to remember that exception of physically occupying the house after absence, which has not been the case. Therefore, I could not deem it. These 109 months are the months of occupation. Specifically, out of 109 months, they have told me that, look, out of 109 months, there are the 96 months in which the accommodation was also being let. This came to tell me that the 13 months are the months in which it was fully occupied then. So I simply came down to write it this way. Then out of 96 months, I just have to listen to the proportion that they suggested. 1/3 of the house has been let out. So I just have been able to take the 1/3 of that to get me the answer of the letting 32 months. The balancing figure that I found was turned out to be the months of occupation. These three figures, we have picked it. which turned out to be a figure of 86. Multiplied by this to get this answer. Well, the letting relief is going to be the lower of three things: £40,000, amount of PPR as worked already, and the gain that attributes to letting period 32 by 157 multiplied by the gain. The figure was found up to be as 17712, which overall we have found to be the lowest one. And I did use this amount up there. The figure of 21587 has been found, which is where pretty much this discussion that was started 1.5 hours ago has been finished. One thing that you will have to pay attention to also in the last, you should not be forgetting the liability computations for capital gains, £1 to 37700. The rates of taxes are 10%, and more than what goes above to that mark, the rate becomes 20. These are the rates that we have occasionally applied many times in the past 4 to 5 sessions. Specifically in the first chapter of capital gains, where we didn't understand for the very first time how to calculate a capital gains tax liability. What I am going to write the very first time is this: 18%, 28%. Now, these rates that I have been able to write are the rates for residential property, which right now is a topic of a moment. Topic that we are discussing it now is on the residential property. The rates for that one has to be this. The rest will be same except the rates. Where did I write this out? Just next to it, if you look into that watchfully, gains on the disposal of residential property will be subject to 18 and 28 instead of 10, 20. So rate has just changed, nothing will. Same band limit, same mechanism you have to use, just the rates 18, 28. Only applicable to house, residential property, not applicable to any asset we have done in the past, only applicable to this one asset, which today, right now, we in discussion of a residential property. Okay with this? So main investment of time is onto months. Even when we have done the question of PPR, we have fought really hard with those months. Even when we are working this question up, we are really fighting it hard with the months. And this is how the way you have to make the whole analysis, divide them into parts and take decisions part by part. Okay, 48 months, let me concentrate onto that first. Because if you will be mixing it up all, you will mix yourself into it. You just have to concentrate onto 48 first. Okay, let me first talk about this 48 months so that then I can concentrate on 109 months afterwards. In 48 months, he has been living with his brother. Means these are the months of absence. I can certainly deem the 9 months out of it for surely. Then what about the rest of the 39 months? Can I deem it? Yes, I can deem it based on that any reason 36 months, but then I cannot, since he never got back to physically occupy the house. In that case, the deem rules cannot be applied. After once you're done with this, then you focus on to 109 months. These are the months of actual occupation. Then you have to ask the question that, okay, out of 109 months, they are suggesting for 96 months, the accommodation was let out. It means what about the rest of the 13 months in which it was not, it was fully rather occupied. Then within those 96 months, not the whole portion of the house was let, 1/3 of it. So I just have been able to take a 1/3 of it. This had given me few months of extra occupation also, which I collected it out all to work the PPR with. This I have used to work the letting with, which in the end we did select because I found this answer to be the lowest one. But imagine if this figure was the lowest one, I would have picked this. But we have picked this. Okay with it. No problem. Got it right. Pretty much ends up with the toughest of all the chapter of capital gains by spending effectively 2 sessions onto it. The last whole session, half of the session of today, and half of the session even a week before when we have done rollover relief. Safely, this chapter has taken 2 sessions of 3 hours, which gives us this kind of a feel that, yeah, this chapter has got something serious going on, something lengthy going on, something complex going on, something important going on that need to have a good revision of that by being a student. Fine with this. Did I leave anything aside out of any page you see? May it be an application or reading the text, highlighting this off, anything from anywhere. When you will revise, you have to sit it in one good time and revise it in a continuation. Specifically, the first four reliefs need to be worked together because these are all in relation to business assets. While this one, you can take it into another sitting, since the two of the reliefs we just have talked about are totally different from what you have done it in the past on the rest of the reliefs. Pretty much ends up the chapter of capital gains. Okay with this? No problem. We will take a break for 10 minutes. When I will resume the session after 10 minutes, we will have something coming to our way. So do not leave the course. Stay tuned. I will see you in 10 minutes to resume the session. Okay, I'm back, hoping you're also back with me in the continuation of the course of today. So that's the situation of capital gains. The sections we have started off this 5 sessions ago. We finished ourselves with the chapter number 17, 18, 19, and 20. All of those chapters were in regards to individuals. Now we are taking a shift towards the capital gains for companies in chapter number 21. As you can see onto a screen. For that reason, let me bring up the chapter 21 lecture notes in front. Just give me a minute. I have to find it first before I can make it available to you. Okay, so chapter 21, capital gains for the companies. As you can see, the title of this chapter, capital gains for companies. I will take you directly onto a page where the pro forma is shared. The way the company calculates the capital gains, I have been able to present a pro forma in front, which is no difference to what we have done in the past 4 to 5 sessions. I can place it in front for about a minute and you can try to read it from the top to the bottom, where you also will realize that's the same story. Except the only difference you have found is to have it in this in the session that only applies to companies, only applies to companies. Whereas the rest of the stuff, the same as before, gross disposal proceeds, incidental cost of disposal, the cost of acquisition, incidental cost of acquisition, enhancements cost, same as before, except that requires to have an explanation. What is it? How to calculate indexation allowance? First time probably you have seen this term since the start of the course, and I need to explain and invest time onto it. Let's get on. Have you seen the performer? Do you see anything so much different from the way the individuals in the past, they have been computing the gains? Now, today the company will calculate the same as before, except the difference is only into that one figure. So what is it? How to calculate? What's the whole aim of deducting it out? So for companies, we take the same proceeds as we take it for individuals to calculate the cost. This is called as an index gain. These gains are not taxable unless or until we come to subtract the effect of indexation allowance from the gain that we get after to the deduction of indexation allowance is said to be as index gain, which is the final level of gain. We also call it to be as chargeable for a company to pay a tax at, because the companies are not entitled to exemption, annual exemption. Individuals are 12300, the companies are not. So the gain that we get after subtracting the indexation allowance is the final one, which is also called as chargeable gain. So main discussion is, what is it? Why are we deducting it? What's the whole purpose and how to calculate? Indexation allowance is in fact filters out the effect of inflation. It takes the effect of inflation out of gains to calculate the real gains. Filters out the effect of inflation to calculate the real gains. It's a mathematical calculation. I have to explain to you all the process of calculating it once, and then you have to keep on applying the same process. But what it does, it takes the effect of inflation out of the gains to calculate the real gains from the date of purchase till the date of disposal. How to calculate it? The calculation of that is so easy. It takes us the indexation factor multiplied by the cost. The cost could be the cost of acquisition or the cost of enhancement. Because acquisition day could be one day, enhancement day could be another one. So we must have to calculate separately for the cost of acquisition and cost of enhancement, because the inflation will be different from the day an asset was acquired or the day it was enhanced. Enhancement could happen after 2 years, 3 years, 4 years. So we will have to calculate the indexation allowance separately for the acquisition day and separately for the enhancement. Factor will be given to you in questions. You will not be worried about. It will be given in questions. A factor which will be rounded off to 3 decimal spots will be given to you. Just need to multiply this with the cost to calculate the answer. And once you get this answer done, deduct it from this side to get the answer. If you look back into the lecture notes, if I bring out the lecture notes in front, see indexation allowance takes out the effect of inflation from the gains to calculate the real gains available from the month of purchase till the month of disposal. We will have one simple question to apply this on before we can start bringing some complications into it. Very basic question that has been given down below, which requires us to calculate the chargeable gains for the companies. Peter Limited, this is not an individual, rather a company. Peter Limited bought a factory for 160,000. Should be the cost of acquisition back in 1997. Company spent this much on extension. See, extension cost is incurred several years after the date of purchase. And the factory was sold for 400,000. Just requiring us to calculate the gain, which is a very simple, easy question. This is going to be the cost is given as 160,000 and the extension cost is given as what? 39,000. This is called as unindexed in 160 plus 39 minus 400,000. The figure is 204,000. Needs to subtract the indexation allowance. A simple calculation, which for the very first time you are seeing me doing it, but believe me, a very simple, straightforward calculation. So once done task, to look into it, you'll be fine with. Let's go to work. Two zero one triple zero. Okay. If the answer is 201,000, let me correct it. Thanks for correction. Indexation allowance needs to be worked separately for the acquisition and separately for the date of extension. October 1997. March 2020. I've been able to write those dates along for us to use the relevant factors, since the question provides us with multiple factors. Which one exactly we're going to choose it from totally depends upon the dates involved. Let's go with the calculation of indexation allowance for the acquisition. The date of disposal obviously is going to be the one same day, Feb 2021. The factor is given to all of us is 0.856, but we will have to use the one which has been given to us for the October 97 to Feb 2021. And this is where you need to understand one thing. The indexation allowance, whatever the calculation we are doing, it has to get frozen on December 17. That's been written on the same page. Importantly, indexation allowance, whatever we are working, has to be frozen. This is the cutoff date. Beyond to that mark, we cannot work the indexation. So if the asset is purchased before December 17 and disposed after, then you must have to take an indexation allowance till the point. That point is December 17. Like in this application, you're providing us with the indexation factor for the December 17 and also for this. So the one that we have to choose is going to be the first one, not this one. Actually, it should run from October 97 to Feb 21, as even the solution suggests. But we have to stop ourselves at December 17. That is a cutoff date, cannot look beyond to that mark. So I'll have to see the factor that runs from October 97 to December 17. 0.856 multiplied by the cost of acquisition is 160,000. Answer is pretty much worked. One 36960. Coming down to the extension, the cost of extension has been incurred altogether after March 2022. And that's after. So if the cost is incurred after December 17, indexation allowance will not be applicable to it. Not applicable. Why not applicable? See, the cost is incurred after December 17. So after December 17, we cannot have a chance of taking the indexation even. When the cost is incurred before, till December 17, we can take. But if the cost altogether is incurred after December 17, then on that, the indexation allowance cannot think of working even. So for that reason, the factor that they're providing to all of us from March 2020 to Feb 21, not applicable. This is the only thing in this case you have to understand. Rest is just the calculator job. Factor will be provided to you. You multiply it by the cost to get the answer, which is what we have. A simple calculation to start with. 201,000 minus 136960. The figure has turned out to be 64040. So company has to calculate the gains normally. The gains that we get is called as unindexed gain. To make those gains chargeable, one has to subtract the indexation allowance, and the calculation of that, you people have seen it. And after you have seen it, you feel it like it's nothing. Because when I say it, sometimes you feel it like probably it's easier for me, not easier for you. But now after showing you the whole the process of that, you probably have felt there was nothing except the question provides us with a factor. You multiply it with the cost to get the answer. And then you minus the same from the gains to get the final answer. A care is required that if the cost is incurred before 17, disposed after 17, then you have to stop yourself till December 17. Don't choose the factor that runs till Feb 2021. Choose the factor that runs till December 17. But if the cost altogether is incurred after December 17, like this is the case, for that case, the indexation allowance is not totally applicable. Okay with that? This is in writing, it's all written. When an asset is purchased prior to December 17 and subsequently sold, the indexation allowance will be given from the date of acquisition till December 17. And when an asset is purchased as from that date, no indexation allowance will be allowed. Both of those bullet points that you can see over, I have been able to explain by taking this application, and you get to learn better when you see a demonstration of it rather reading the text. Indexation allowance is calculated. How? By multiplying the factor to cost. Will be provided to us. That is what you see on that left-hand side being written, and we've been able to finish it. Okay. Specifically, I've mentioned annual exemption is not available to companies. So whatever the answer we have got, this one is the final one. the company will have to pay a tax on. So it's called as chargeable gain. It's called as chargeable gain. Because for individuals, we come to subtract the annual exemption 12300 to make those gains taxable. We always have subtracted. This is the final answer. Okay. Another thing that needs to explain in individual, have capital gains. The tax the individual pay on that is called as capital gains tax. But if the company on the other side is involved, if the company on the other side is involved, the tax the company pay is called as corporation tax. That is called as corporation tax. And the corporation tax rate is flat 19%. No band limits to be used except flat rate at 19. So the gains that we have worked, whatever, it's written, the companies pay corporation tax on the gains which are taxed at a flat rate of 19%. So we will learn the corporation tax later on, but only the one part of the corporation tax we're finishing today, and that part is capital gains calculation. For that reason, at least you need to know, okay, if the company has gains, the company pays corporation tax onto it, not capital gains tax. And the rate of tax is 90%. So gains that I have got into this question, if I have to calculate the tax onto it, I will simply be able to multiply 19% with that to get me my answer, because the companies are not entitled to any sort of annual exemptions. This is the final gain that needs to be multiplied with 19% to get the answer of corporation tax. That's being written even onto the top. The companies pay corporation tax on their capital gains arising in a particular accounting period. The calculation of the gains is that the same for individuals, except for the following differences. And these are the differences that we are talking about. The one of that I already have talked about. So this chapter is all about, you see, this is the page of explanation only, followed by questions to answer. Because you may calculate the capital gains for individuals or for companies, has to be the same way. Except there are a few differences, which is where we are concentrating. You already have seen the big difference, indexation allowance, that we do not apply to individuals, it applies only to companies. And simple calculation, not so much of length was involved, factor multiplied by cost. A little bit of care is required where that point I was explaining to all of you, that point of December 17, if the cost is incurred after, indexation allowance not applicable. If the cost is incurred before, disposed after, then from the date of acquisition till the December 17 point, we have to use the factor to calculate the indexation allowance. Where are we heading towards in the continuation of it? See this. Look, case one, where I suppose the sale proceeds are 80,000. And the cost is 50,000. What if the indexation allows us 35,000? What if? Can happen or not based on the calculation. People have understood factor multiplied by the cost. What if the indexation allows us 35,000? The loss is going to be created. Cannot happen. Cannot happen. The losses cannot be created. The losses cannot be created. Indexation allowance cannot create the loss. We can deduct the maximum. The gains are there to absorb. Losses cannot be created. This is the point that I'm explaining to you of, which says the indexation allowance cannot create the capital loss. Cannot create the capital loss. In the second situation, case number 2, see, arithmetically, the loss was going to be created. Are you all focusing? 35,000, if I come to subtract, the loss was going to be created, but cannot be created. It's a case number 2, where the cost is 90,000. And we have a loss. Already we have a loss. We already have a loss. The indexation allowance supposes 20,000. So losses has been enhanced. Arithmetically, the loss has gone up to 30 from 10,000 mark. It has gone up to 30. This cannot even happen. The losses cannot be enhanced. The losses cannot be enhanced. This is the case where the losses cannot be had. Capital loss cannot be enhanced. Or with indexation, if I write this, indexation allowance cannot enhance the loss. Cannot enhance the loss. This was about cannot create. This is about cannot enhance. Two other different cases. You can't be calling the two cases to be the same one. Different cases. In one case, you already have got the loss, which was going to be enhanced. Cannot happen. In this case, we have again with the deduction of indexation allowance, the loss was going to be created. And we have not even. Okay, now once you have got the loss, what to do with? How to relieve it? These losses are carried forward. To relieve it against the capital gains of the loss-making accounting period of the future accounting periods. Simple, small discussions these are. Have to keep that in mind, capital future accounting periods. When you carry the loss forward, it is always to be on the infinite basis. Carry forward to relieve the loss against the capital gains of future accounting period for infinite number of years. This has to be done. Infinite number of years this needs to be done. So first thing is that the indexation allowance cannot create a loss. When in that case, the loss is not created, let's not even talk about we have a loss. But in this case, when you have an original loss, which we have not enhanced, so how to relieve that loss? By carrying it forward and setting it off against the capital gains of future accounting periods. This is what has been written on the next. You can read it. Indexation allowance cannot create or enhance. Needs to carry forward to set it off against the capital gains of future accounting periods. Cannot or enhance. I have been able to explain the whole two cases by making the examples onto it. Because when you read it out, sometimes most of the time you cannot guess it out. What does that mean, creating or enhancement? You get it out only when you see a demonstration of that, the figure work onto it. On this, we have a formal question, application 2. Let's go to solve it. Calculate the chargeable gain or loss arising under each of the three alternatives. Factor is given to us as 1.212. And see, they're providing us with a factor that runs exactly in that period. George Limited is considering selling a field in September 2020. They acquired the field back in 2005 for 90,000 and likely to be one of the three figures. The sale proceeds are being given to us. So basic answers I have been able to work under each of those cases. Let's think of using the indexations now. Part A is like a normal case, part B is like a normal case, but part C already have got the loss into it. And now I need to subtract the indexation allowances. $1.212. The cost is 19,000 multiplied by 212. So this is the indexation allowance. I will subtract 23028, which will be the same for all the three cases. But in that case, you should not be forgetting that indexation allowance cannot create the loss. So the maximum that I can subtract is the amount of the gains those are there to absorb. And third column, the one in which I will not altogether subtract even a single pound of indexation. Our figure is 9972. A question which has a revised the idea of, okay, you cannot create the loss, you cannot enhance. The loss is already there, it cannot be enhanced. If I had subtracted the same indexation of 23028 from, it would have enhanced to 30,000, something cannot happen. Or if I subtract the 23028 from, the losses would have been created, cannot even. So far, easier. Two applications onto that page you have seen, I have been able to explain. The pro forma itself on that page is totally a repetition, except that indexation allowance was the only thing required to have an attention, which we already have paid. Two of those portions have even been finished. What is the title? What is the written there? I absolutely scan it out, every possible thing from the lecture notes. When we do it, it has been the case in the past 5 sessions you have seen. Just to give you that confidence of that later when you try to open that chapter onto your side, you'll be having this impression that I already have done everything. Even back into lecture notes, the things, the way those are written, truly a representation of what we do in the class by making lots of examples. And can't you see smoothly this chapter is going on? Because we have not started off with something else, not a new world. It's still the same topic of capital gains. Only the nature of business has changed. We had been working this from regards to individuals in the past, sole trader. Now we are working the same in regards to companies. So type of business has changed, type of income has not changed, which is still the capital gains. So the capital gains, the individuals, no matter they work, or the companies they work, more or less the same, except the differences, which is where we are paying attention towards. Already have completed the 2 boxes of it. Getting into the third one. This we will take a little while after, if not today, the next week. Release. Now, this is the chapter we just got over to. Today itself, we have finished the chapter and we have studied how many reliefs in it? 6 of them. Rollover, gift, business asset disposal, investor, principal private residence, and letting. 6. What is written there? The only that applies to company is which one? Out of 6, the individuals that they get the benefit of that, the company gets the benefit of only the one. And the very first one, rollover. And same way as it was for individuals in the past, means the way will not even change, the way that we have talked about full rollover, partial rollover. Goodwill is not going to be a qualifying asset for the purpose of rollover relief. It means what? We have to take just a question to practice it from the perspective of company, since the same way, even the company will get the benefit of ROR. So I do not need to explain, except I rather have to go and work the example on it. When I have explained to you all the topic of ROR, we have had a long debate on each case, full rollover, partial business rollover. This application 6 is in fact going to be a repetition, but we're working this out with regards to company. The difference only is this. Why did I leave the 3 questions on the way? 3rd, 4th, 5th one? Because this will cover this side we have yet to look into. We will visit it. Let's complete the application 6 on the first. So ABC Limited has sold the fee of factory for 200,000. The company had acquired the factory on September 2007 for this much and has always been used for the purpose of business. So cost given, proceeds given, not a big deal. We can calculate the gain. The gain we will calculate from the company's perspective will be called as unindexed gain. And then we will try to do what? Factor multiplied by the cost, indexation allowance, the gain will become index gain, same as above. Explain the capital gains tax implications for each of the following alternative courses of action that ABC Limited is considering taking. In the first case, they have acquired a large whole factory for this much and acquiring a factory for this much. 2 options. Why do I have? Because in one case, I will be able to cover full ROR, and in the second one, I will be able to cover partial ROR. Factory disposed, factory acquired. For how much they have sold the whole factory for, when what was the date of disposal? In June 2020, there has been the sale. Jan 2021, there has been the purchase. For how much this in the past been purchased out for? 72,000. And for how much it has been sold out for? 200,000. The unindexed gain is 200,000 minus 72. The figure is 128,000. So finding the unindexed gain and all the same as story from the past 40 minutes or so we are into right now. Proceeds minus cost, unindexed gain, and even to find the index gain, now we will come down to subtract what? Indexation allowance. Factor multiplied by the cost, 0.654. The cost is 72,000. $47088. Finding the index gain, the same process as above, and finally now we are here to apply that rollover relief the way we have understood that back into courses. Is this the way we have worked the gains in the past 45 minutes, starting off with proceeds minus the cost? This is what we call it as unindexed gain. Factor multiplied by the cost, index gain. The new factory, they're acquiring it for how much? They're acquiring the new factory for 270,000. Okay, this is where we will come down to apply the rollover relief. The discussion of the rollover relief was always like you sell out the one factory and you collect the money onto that disposal of invest into the new one to buy the new factory with. Just because the cash is invested in, the gain for a time being rolls over, defers, and then the base cost calculation comes onto our way. All from the last week of explanation you can recall. Because I'm reminding you of topic is capital gains. No matter today if the type of business has changed, that won't change the topic of RAR or rollover. Conditions were the asset that has been disposed, the one they have purchased, both must have been qualifying, which is a factory business asset qualifying. Investment has to happen within 4 years. 1 year before, 3 years after. So that looks to be invested in about few next months. Condition looks to be perfectly fine. The qualifying asset, the one that has been disposed, the one that has been purchased. And there is an investment going on within that 4 years time. The last thing that needs to be seen into it, if they have invested fully, partly, which looks to me fully invested. So whole of the gain on this side is going to be deferred. We'll deduct it from the cost of the new asset to calculate the base cost. Which later on one has to use for the purpose of calculating the later on, whenever this factory will be sold after a year, 2, 10, 20, 30 years after, the base cost will be used for the purpose of calculating the gains. Do you see by any far I have brought any change into the explanation, the way the rollover relief was explained? I can open the file of chapter 20, the board work of it in front, so that in the live course also I can try to just show to you the way the rollover relief was once done when the very first relief we have done was the rollover relief. And the explanation was the same way as I'm explaining to you right now. See the qualifying asset, the qualifying period of investment has to be 1 year before, 3 years after. All the money was invested in. So whatever the gain that we have found it onto that side was deferred, which we came down to subtract it from the cost of this asset to calculate the base cost, which later on had been used to calculate the gains. Same process over here we're applying. The difference only is what? In that question, we have an individual like me. In this question, we have a company, limited company, PLC or private limited company. Topic will not change. Relief will not change. The same way I have been able to apply. Yes, the second difference that you can spot is where individuals are involved. We don't bother to work any indexation and all. The gain, whatever we have, you try to rolls over. But in the case of company, you first have to find the index gain, which will be rolled over. And to calculate the index gain, we've been spending the time the last 40-45 minutes on how to calculate the index gain minus the indexation allowance equals to index gain. To calculate the indexation allowance, we use the factor multiplied by the cost. This is the one that will be deferred, which we have. Okay. Now, in the second case, if they are acquiring the new factory for 180,000, what sort of difference it will bring it in? Let me copy and paste this entire solution so that I can try and bring a bit of change into it. And the new factory is going to cost them around 180,000. So proceeds have been partly invested. 200,000 is what they have collected. 180,000 is what they have invested. The portion of the proceeds that they have not invested will become chargeable immediately. That's how the way, even in the past, we have charged the gain. While the indexation allowance thing obviously will not be different, will be the same as above. Do not know why I did I rub this off, because indexation allowance obviously has got nothing to do with what we roll over later. So it will be the same as 80192, 912, 80912. So how did we charge the 20,000? This is the money that they've collected. This is the money that they've invested. The part of the money that they've not invested is 20,000 will become chargeable immediately. And the balancing figure will defer, which is 60912. The process of calculating the base cost will remain to be the same as before. 60912, the figure is 119 088. What is new in this question that you are working it? The one is on the full, the second one is on ROR, partial because they've invested, partly not fully. So part of the gain has been deferred. The part has been charged. What has been charged based on a very simple logical explanation. I have done it back into individuals that today I'm also being applying. 200 is what they're collecting. 180 is what they're investing. So part of the money that they've been able to keep onto their side, they become liable to pay a tax onto it. 20,000 became chargeable because that was not invested. This was deferred. Deducted it out from the cost of the new asset to calculate the base cost, which tomorrow when they will sell the asset to someone else, they will be using it. The calculation of gain. Even while the time I'm doing it, even you have half revised, you have not revised it, you have got this feeling in your mind that it's totally the same as above, same as before we have done for individuals. And that makes this chapter to work in smoother manner. As you can see, the past 50 minutes, we have been into this course and we have finished this off chapter by 75% already. Already 75% finished this chapter, except this one explanation being left, which we still can do. Do you see anything on this page that I missed it out except this one thing that's been left behind other than this? From this and that side, from this side, this side, this side, or this side, except this page and this explanation. Six reliefs, the individuals in the past, they have to consider it. The company is only entitled to the one. And that is on even the same basis. As you can see me working the question. If there was any change, I would have explained that. Even it's written in so clear words, same way as it was for individuals in the past. Shares and securities. In fact, the second chapter of capital gains when we have done was the shares and securities, in which you had seen me using those matching principles. Right issue, bonus issue, takeovers, reorganizations. Matching principles, I've given you the whole idea of that. Why do we have to use? What's the whole need of? Now, if you try to look into the matching principles today over here, you probably will see a bit of change into it. You probably will see a bit of change into it. You probably will see a bit of change into it, or may not. Totally depends on if you're keeping the revisions with you, then you will be able to see this and say that, yeah, there's a bit of change into it, and I can highlight that change. What is a change? Try to read those 3 points. First of all, there are 3 principles. We even have seen 3 principles for individuals in the past. Now we also can see there are 3. And more or less, I'm having this impression that looks to me same kind of the rules we had seen before we are watching it, but exactly where there's a bit of difference. If someone can write me into a chat box in the matching principles for companies. So started getting those answers and suggesting the rules are different only in the second point, because the first and third one are the same. First principle was like always to match the cost of those shares those I have acquired itself on the same day of disposal. Third was from the pool. Second was following 30 days, which right now is previous 9 days on FIFO basis. This is exactly the difference is there. So mechanism will not change. If one rule slightly has changed, that will not change the way I have worked the explanations on share pool at that time, using the other matching principles at that time. Just one change we have found, and that change I also can highlight it for you. The same moment, if I open the lecture notes of chapter 18, see, these were the matching principles, same day disposal within next 30 days share pool. So these 2 are the same, in fact, first one, the third one. Well, this one is different for companies. They had wanted us to look into 30 days next for individuals, but for companies, they want us to look back into last 9 days. So even in that chapter, when we've talked about, we have taken an example in which people did understand for the very first time how to make the use of matching principles. And these 2 questions has enabled us to understand the right bonus issue effects. Same way, in the chapter 21, this first question will enable us to understand the way the matching principles we have to use. While the next application will bring what into it? Bonus issue. This question will bring what into it? The right issue. So on the same pattern, 3 questions being planned, the way that we have performed 3 questions at that time. The first question was like using the matching principles generally. The next 2 questions were having the bonus and the right issue in. Same way for chapter 21, the first question will about using the whole of those principles, and the next 2 will have the right and the bonus issue coming in. But obviously, these questions will take a bit of time to solve. We'll keep it for the next course to work. Probably will take 30 minutes or a little more of the next course before we'll be able to start off with the new chapter afterwards. Okay. But it takes a time when you practice, when you learn things so much, and the 3-hour course, you do not realize when it started, when it ends. We started the course with today the explanation of PPR, which itself have taken quite much of a time, an hour of explanation on PPR relief. Remember that application 8, moving to Boston, Manchester, Liverpool and all, PPR relief, deemed of interesting relief, but has taken about 1 hour to finish. But some areas, those were connected to that relief was business use of accommodation. And then you have people have seen me charging the gain that was belonging to business side and exempting the gain that was belonging non-business side, 1/5. Letting relief was also an explanation that has taken a bit of a time, 30 minutes or so. So all in all, by spending a little over to 1.5 hours, we have finished the 2 of those reliefs. Then we got into the explanation of this companies, and by spending the last 1 hour onto it, quite much has been finished. And whatever the part that we have finished, you are gaining that kind of impression that it's easy. It's nothing so different from individuals, except indexation is the only main highlight which one can say to be as a different thing from individuals. Otherwise, overall, I'm still calculating the gains the same way, relieving the losses the same way by carrying forward, applying the rollover relief the same way. And even the pool, when I will construct bonus issue, right issue, when I will apply, the difference will come in the incorporation of indexations into it, which never for individuals in the past we have done. Okay, fine. So that is, of course, so today we will commence the course of next Saturday with the continuation of whatever we are leaving our today course at. Have a good time with your family onto this weekend. I will see you in the next course to continue. Thank you very much.